Good day. Today we will focus on the profits and loss account and also the trading account. The information provided below is extracted from the records of Mwasha traders. You are expected to prepare the following accounts for the year ended 28 February 2020. So if the year is ending on 28 February 2020, it means that this year started on 1 March 2019. So this is a full 12 months. Okay, we are told to do the trading account and also the profits and loss account. So when you are doing the trading account, let me open the trading account here account. So this is the trading account. So when you are doing the trading account, on the debit side, you must have the cost of sales. Okay, debit side you must have the cost of sales. So it is GJ. And then on the credit side, you must have the sales. So now let's go to the trial balance. So we are focusing on the nominal account section. So when you are doing the trading account, the first thing that you must do, you must take the money of sales and then you subtract it with the money for the debtors allowances. Okay, you need to show that in bracket. So it's 1,267,000. It's 1,267,000. So here the year ends on 28 February 2020. The year ends on 28 February 2020. Okay, minus the debtors allowances, which is 15,800. Okay, so before we close the bracket, we have to go to the adjustment and check if there is anything that is affecting the sales or the cost of sales. So if you can check here, we don't have the adjustment that is affecting the sales and the cost of sales. Now, the cost of sales, they are how much? Cost of sales, it is 597,000. 597,000. Okay, now let's find the difference between the two. 1,297,000 minus 15,800. So this is going to give you 1,281,200. Okay, now the next step is we check which side is bigger. So you can see that the bigger side is the credit side. So you must equate both sides with the bigger side. So the bigger side is the credit side. So therefore, we equate both sides with the bigger side. Now we must find the difference. So the difference is 597,000 is equal to 684,200. 684,200. So we call this a profit and loss. So this is going to the profit and loss. So actually this is a gross profit. Okay, so it is going to the profit and loss, to the credit side of the profit and loss. Let me open the profit and loss account. Let me open the profit and loss account. Profits and loss. So in the profit and loss, on the debit side, we record all the expenses, and then on the credit side, we record all the incomes. Okay, so by transferring this 684,200, that is coming from the trading account. Okay, so it is 28 February 2020. So if you don't know how to prepare the profit and loss, I suggest you go to my previous video which is saying that profit and loss introduction. So where I'm talking about the trading account, how to prepare it, and also how to prepare the profit and loss. Okay, let's continue. Now, let's go to the adjustment. Adjustment number 1. Ohaju, a debtor who owes 900 Rand, was declared insolvent on 28 February 2020, so at the end of the year. So this debtor was declared insolvent, meaning that this debtor no longer have any money. So his estate paid 45 cents of the rent, meaning that his estate paid 45%. Okay, so his estate paid 45% of what he was owing. Okay, so if his estate paid 45%, it means that the remaining one is 55%, right? And then they are saying that the balance must be written off. So we must write off this 55% that is remaining. So we are going to say 900,000 times 55%. That is 495. 495. So this is the amount that must be written off because the 45% it was paid. Okay, now here we are given the bad debts. So we have the bad debts. So GJ. So they are how much? 5,900. And then the new one that must be written off, that is 495. 495. This happened on 28 February 2020. So now let's add these two. 5.9. This is going to give us 6,395. Okay. The next one. Number 2. Rent for March has already been received. Okay. Where is the rent income? Because we are saying we are told that you have received the rent for March. Here is the rent income, 52,000. Let's go to the credit side because the incomes they are recorded on the credit side. Rent income, GG, 52,000. Now, our year ends on 28 February 2020. But then we are told that we have already received the rent for March. So what does this mean? This means that we have received the rent of the next financial year, while our year ends on 28 February. So what does this mean? This means that this rent income of 52,000, it is for 13 months because we have already received the rent of March, which is the next financial year. So now we want to know that how much is the rent per month. So we divide by 13 because this 52,000 is for 13 months. 52,000 divided by 13 months, it is equal to 4,000 Rand. Now, we have a rent income, which is for the next financial year. It has been received and it does not belong in our financial year. Now, what is the matching saying? The matching is saying that incomes, they should be recorded in a year that they belong in, even if they have not yet been received. But they should be recorded in a year that they belong in. So now we have received the 4,000, but it is not belonging in our financial year. So therefore, we must come here and subtract it because it does not belong in this financial year that ends on 28 February. Okay. 5,000 mean 52,000 minus 4,000, it is 48,000. Okay. On the 1st of January 2020, an amount of 960 was paid for the placement of weekly advertisement for a 3 month period. Now, on the 1st of January 2020, remember, our year ends on 28 February. So we are told that this was paid on the 1st of January 2020. Okay, it was paid on the 1st January 2020 for the placement of weekly advertisements for 3 months period. So we are told that this 960 is for 3 months. Okay, so if it's for 3 months and it was paid on the 1st of January, it means that it is for January, February 2020 and March 2020, right? But then if you can check, our year ends on 28 February, meaning that we have paid the advertisement of the next financial year. We have paid for the advertisement of the next financial year. Now, what do we know? The matching concept, it is saying that expenses, they should be recorded in a year that they belong in, even if they have not yet been paid, but they should be recorded in a year that they belong in. So this means that we have recorded something that does not belong in our financial year because we paid it, but then it does not belong in our financial year. So we want to know that how much is the advertisement for each month. So we are told that this 960, it is for 3 months. So we divide by 3 months. 960 divided by 3, that is equal to 320. Okay, so here's the advertising, 5.2. Advertising, 5.2. GG. So what must we do? We must go to the advertising and subtract the 320 because it does not belong in our financial year. Remember, this 320 is 324 January and also a 324 February and also a 324 March. So we are subtracting the 320 of March because it does not belong in our financial year. Okay, so 5.2 minus 320, that is going to give us 4,880. Okay, now number 4, the monthly insurance premium of 750 has been paid 1 month in advance now. So we are told that we paid the insurance for 1 month in advance. And we are told that the insurance per month, it is 750 because the insurance premium, it is 750 per month. Okay, we are told that we paid 1 month in advance. What do they mean when we are saying that we paid 1 month in advance? It means that we paid for the month of the next financial year. Okay, it means that we paid for the month of the next financial year, which is not good because we know the matching. The matching, it is saying that expenses, they should be recorded in a year that they belong in, even if they have not yet been paid, but they should be recorded in a year that they belong in. Okay, so Actually, this is called a prepaid expense when the business pays for the expenses of the next financial year. Even this one is a prepaid expense. But you can go to the video where I've explained the prepaid expense, then you'd get a better explanation of the prepaid expense, where the business pays for the next financial year. Okay, so we paid the insurance of the next financial year. The insurance is 8,700. Insurance, it's 8,700. So we paid the insurance of the next financial year because we paid for the 1 month in advance. Okay, so we must go to the insurance and subtract this 750 because it does not belong in our financial year. 8.7 minus 750, that is going to be 7,950. Okay, number 5, an employee M. Sadige was underpaid on February 2020. February 2020, this is the end of our financial year, in error. So he was paid and he was underpaid in February 2020 in error. So meaning that they made an error. The difference of 2,500 will be paid in March. So now the business has realized that there was an error, but then they are saying that they are going to pay this employee that difference in the month of March. Now listen to this. What is the matching saying again? The matching is saying that expenses, they should be recorded in a year that they belong in. Yes, it will be paid in March, but then it belongs in the year that ends on 28 February, right? So therefore, we must go and add this 2.5 in the salaries and wages. 247,000. Plus 2.5. So 247 plus 2.5, 49,500, right? Okay, next one. The next one, number 6. Interest on fixed deposit has been received 3 months in advance. So you have received the 3 months in advance, meaning that you have received the interest of the next financial year, which is for 3 months. Okay, interest on fixed deposit, it's an income, so it must be recorded on the credit side. Interest on fixed deposit, so it's how much? 12,000. So we are told that we have received the interest 3 months in advance. So we've received the interest of the next financial year, which is 3 months. So we know that the matching, it is saying that incomes, they should be recorded in a year that they belong in, even if they have not yet been received. So we have received the interest on fixed deposit for the next financial year, right? It does not belong in our financial year. So therefore, we must come and subtract it because it does not belong in this financial year. Okay, so 12,000 minus 2.4, that is 9,600. 9,600. Okay, number 7. An internal auditor found that the bank charges of 500 Rand has been incorrectly debited in the sundry expenses account. Okay, we have the bank charges. Let's go to the bank charges. They are 4,050. Bank charges, they are 4,050. Okay, and then we have the sundry expenses. How much are they? The sundry expenses, they are 13,000. Now let's go back to that transaction. The transaction, it is saying that an internal auditor found that the bank charges of 500 Rand has been incorrectly debited in the sundry expenses. So sundry expenses, expense, right? So the expenses, what happens to the expenses on the debit side? They are increasing, right? So it means that this 500 Rand, it increased the sundry expenses, while it is for the bank charges. It does not belong in the sundry expense account, it belongs in the bank charges. But then it was debited to the sundry expense account. So because this 500 Rand, it does not belong in the sundry expense account, we must go and decrease it from the sundry expense account. And then is the 500 Rand for what? For the bank charges. So we must go and add it where it belongs. So it's going to be 4,550. And then we're going to have 12,500. Right? Number 8. Consumable stores unused at the end of the financial year are valued at 1,000 Rand. Okay? Where are the consumable stores? The consumable stores, they are 6,400. These are the expenses. So we have the consumable stores, GG. So the consumable stores, they are how much? 6,400. Now, what happens is when the business buys the consumable stores on hand, the consumable stores on hand, we are talking about the packing material, stationery, it can also be fuel. So when the business buys these consumable stores, at that time when they are bought, they are treated as the expenses. They are treated as the expenses. But then at the end of the financial year, if it is found that some of them they are still remaining, or they are on hand, or they are unused, what we need to do is we need to go and separate them from the expenses account, because they are no longer the expenses, they are now the asset. Now, why are we saying they are assets? It is because anything in a business that can be turned into money, it is an asset. So if, for example, we have a stationery that is unused, so it means that the stationery, we can still sell it and get the money. So therefore, it's no longer an expense, it is now an asset. So therefore, we need to take this 1,000 Rand and go and separate it from the consumable stores, because it is no longer an expense. Okay. Number 9. Provide depreciation on vehicle at 20% per annum on the diminishing balance method. Okay. The depreciation on the vehicles is on the diminishing balance method. So meaning that we're going to say cost price of 410 minus the accumulated depreciation of 160. So it's 410 minus 160,000 accumulated for the vehicles. It is going to be how much? Minus 160,000. That is 250,000. Okay. So, okay. So, and then now we have to multiply this by 20%. So 250,000 times 20%, this is going to be 50,000. So the depreciation for the vehicles, that is 50,000. So we have the depreciation, which is costing 50,000. Okay, now the equipment cost price is 207,000. 207,000. And we are told that it's on equipment, it is 10% on the straight line method. Straight line method, it is the same as the cost price method, meaning that we take the cost price and then we multiply by the percentage. So this is going to give you 207,000 times 10%. This is going to give you 20,700. This is 20,700. So this is 70,700, right? Then the last one, a physical stock count on 28 February revealed an amount of 55,000. Okay, now let's go and look at the trading stock here in the trial balance. The trading stock in the trial balance, it is 55,690. So the business thought that they did trading stock that is worth 55,690. But then when doing the physical stock count, it is revealed that actually the trading stock is worth 55,000. So what is happening here? It means that here the business is losing because they thought that they had more stock while they had less. What do we call that loss? We call it a trading stock deficit, which is an expense. It's a trading stock deficit, which is an expense. So it's 55,690 minus 55,000. So it's a trading stock deficit. So this is going to be 690. Okay. So we are done with the adjustment. Let's check if there is any income or expense that was not recorded. We have the water and electricity, which is 27,400. Water and electricity, which is 27,000. Water and electricity, which is 27,400. What else is not recorded? Commission income. The income, it must be on the credit side. Commission income. Commission income, which is 24,000. What else? Telephone account, 3.8. 3.8. So it is 3.8. This is a telephone. Telephone. That is 3.8. What else? It's not recorded. Sundry expense is recorded in the consumer. Yeah. So we have recorded everything. Now from here we check which side is big. So if you can just from looking, you can see that the bigger side here is the credit side. So let's check that it is how much. Let's check that it is how much. It is 684,000. 684,000. So this is giving us 700,000. So we have to equate with the bigger side, right? So it is 765,800. 700,000, 800. Now we want to check that it is big by how much. So now we have to find the difference. So we're going to say 765, 800 minus the debit side. So minus 3.8 minus 27,400 minus 690 minus 70,700 minus 5.4 minus 12,500 minus 4,550 minus 2 minus 249,500 minus 249,500 minus 7,950 minus 4,180 minus 6,395. So the difference is 372. Difference is 372,035. So we call this a net profit. Net profit. So this net profit, it must be transferred to the capital account. So we are done with our profit and loss account. We are done with our profit and loss account.